Hey everyone, welcome to my brand new dividend stock investing video. I want to cover a stock pick in the video today that is trading at a price earnings ratio of 5. That is right, this dirt cheap stock right now that was spun off from Merck, Merck being a large healthcare company that many dividend stock investors own. The spinoff is called Organon, ticker ORG. I want to cover Organon in the video today in great detail. I'm going to analyze that stock, but I'm also going to compare it to its parent company, Merck. I'm going to throw Pfizer and Viatris into the mix, which are two healthcare stocks that I own. Pfizer having spun off their Viatris unit recently, and I've covered that one here before. It's a great comparable for Organon. I'm also going to throw Johnson & Johnson in the mix as well. So I've got a lot of analysis today in the healthcare sector. Healthcare sector is a sector I love as a dividend stock investor because I see a lot of value there right now. I love buying value. I love buying discount. So get ready, everyone, for a really exciting dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So before we get started, if you love healthcare stocks as much as I do, please smash that like button. It really helps me out. It means the world to me. Please also go ahead and subscribe. I have a goal of 100,000 subscribers, and if you subscribe, it really helps me on my personal goal, and I want to reach as many investors all around the world as possible. So check it out on the screen right now. What you see in front of you is my financial summary of all of these stocks. By the way, if you're on my Patreon at the Thug Life Investor level, I upload all these analyses there, and so check that out. I'll have a link in the pinned comment. I have a lot of patrons over there, and I also have over 37 bonus videos there as well. But basically what you see is my analysis, and I'm comparing all of the stocks that I want to discuss today. And so in the analysis, I want to first zoom in on the three at the top, which are the large companies. I want to zoom in on Pfizer, Merck, and J&J. So check it out on the screen right now. And so what you see first is Pfizer. Pfizer is trading at $39.14. What I love about Pfizer right now is they are just hitting the ball out of the park with their vaccine. And basically, the price earnings ratio on a forward basis this year is a 10.44. It's 11.38 next year. And so this company is a huge global pharmaceutical company. It has a dividend yield of 4%, which is great in this overall low yielding, low interest rate environment where everything's been bid up. It has a payout ratio of only 41.6%. And they've been growing the dividend on average by over 5% per year for the last 5 years. Now, we'll see what happens as time goes on, but some of these numbers that you're seeing in front of you with Pfizer right now are probably a little better than they would have otherwise been, or not only probably, they're a lot better than they would otherwise have been because the vaccine is doing so well. Now, the market cap is $219 billion. Long-term debt. Keep an eye on this because this is going to be very meaningful when we look at Viatris and Organon in the video today. It's only $35 billion for a company that is just of huge magnitudes. It's a $200+ billion company. Now, the net margins here on an adjusted net earnings basis are 36%, but on a GAAP, generally accepted accounting principles, it's 33%. So that's Pfizer. That is a healthcare stock I've covered on my channel quite a bit. Now, I want to compare Merck because Merck is a healthcare stock, another global healthcare pharmaceutical company that I have not covered on my channel before. I do not own Merck, but it's widely respected in the dividend community. It's trading at $77.97 on a forward PE basis. It's just a little bit more expensive than Pfizer, and that makes sense because Pfizer's results are embellished a bit by the vaccine, and so it would probably, because that's kind of more of a one-time thing, surely there will probably be booster shots and such, but still it's trading trading at a lower PE because of that. And so it makes sense to me that Merck would be trading a little more expensive at a forward PE in the 12s and 11s. And Merck has a dividend yield of 3.3%, a payout ratio quite similar to Pfizer's at only 41.9%, but they are growing the dividend a little quicker than Pfizer, and so they're growing the dividend at 7% on average per year. Market cap, very similar to Pfizer, just under $200 billion. Long-term debt, only $24 billion. Boy, keep an eye on that number again. The debt numbers at these big pharma companies are not so bad. And so the net margins for Merck are 29% on an adjusted basis, 26% on a GAAP basis, so a little bit lesser than Pfizer's net margins. Now, Johnson & Johnson, which is my favorite of all, this is my number one favorite dividend stock of all time. I'm actually going to be buying some more J&J, most likely this week or next. I'm really excited about it. I'm focusing on basics right now. As I shared in my last video, I'm just getting back to my core stocks, which are on sale. Maybe not on sale, but at least fairly valued right now. That's why I'm buying some J&J right now. But anyway, check it out on the screen right now. What's exciting about J&J is it's trading at $167 per share. On a forward EPS basis, a forward PE basis, it's trading at a PE of 17 this year, 16 next year. That is reasonable for J&J. It's not as cheap as the others, but J&J is different. It's more like a healthcare mutual fund. This is a company that has pharmaceuticals, has household products, health and beauty products, if you will, and also medical devices. So it's more of a well-rounded mutual fund style company. Although it's not a mutual fund, it's a company that's grown through acquisition quite well. It has a starting yield of 2.5%, payout ratio just a little bit higher than the other two of 44% at 44.5%, and they've been growing the dividend on average by 5.79% per year. Market cap is huge at $442 billion, one of the larger companies that I own. Net margins on an adjusted basis, 31%, 27% on a GAAP basis. So those are the big three, if you will, that I wanted to cover. And what I want to do now is I want to get into Viatris and Organon. So as I do this, what are Viatris and Organon? Basically, Pfizer spun off Viatris, Merck spun off Organon. What these are is they're largely companies that have generics. And so what these bigger companies like Pfizer and Merck realized is, hey, we have all of these legacy drugs, all of these legacy pharmaceuticals. And of these legacy products, we don't focus a lot of time and effort on them because even though there's so many of them, they don't make up as large of a percentage of our revenue nor earnings. Why? They've gone off of patent protection, largely generics right now, and we just don't make as much money on them. So what they thought is, let's spin off these brands into new companies so the new companies can focus on perfecting them, marketing them, focus on driving profits, focus on cutting costs, and just getting as streamlined as possible, while the parent company, the big company, can focus on what's next. They can focus on research and development. Like in case of Pfizer, they were able to bring the vaccine to market, for example. And so that's the type of thing these companies want to focus on. They don't want to focus on getting bogged down in these legacy brands. And so Viatris basically has the legacy brands from Pfizer. Organon has them from Merck. And Organon is going to be focusing on women's health, legacy brands, and also biosimilars as well. And so very similar to Viatris in many ways. And so with all of that, I want to share those on the screen right now. Check it out right now. And so what you see is a comparison of the spinoffs. And basically with Viatris, it's trading at a price per share of $14. Hey, maybe I'll pick up some more. It has been trading at a really good price. And on a forward basis, the price earnings ratio is 4 this year and a 3.89 next year. So Viatris is just dirt cheap, dirt cheap, priced as if it's going to go out of business. I love this about Viatris. They have declared a dividend, 11 cents per quarter, 44 cents per year. And so that dividend yield is 3.1%. Payout ratio is only 12.5%. And so Viatris has room to increase the dividend over time, although they won't be doing that until they pay down some of their debt. And as you can see, the market cap of Viatris is $17 billion, but they have $22 billion in long-term debt. Now, remember, just from before, Pfizer only has $35 billion in long-term debt. So how does this small spinoff have $22 billion in long-term debt? You can quickly see what has happened with these spinoffs. What's happened with these spinoffs is they've been saddled with a lot of debt. And so that's something to keep in mind with these spinoffs is the parent company put a ton of debt on these companies. And I have some really interesting things I want to share with Organon that I found in the appendix of their financial statements that is really enlightening about their debt. Anyway, check it out on the screen right now. And so what you see next is net margins. They're not bad at Viatris. They're 25% on an adjusted basis, although on a GAAP basis, they're losing money right now. So we'll just see how that goes with Viatris. I think things will probably normalize in a net margin range of, say, 20 to 25%, which is surely lower than Pfizer's adjusted kind of 36 or their GAAP 33, which makes sense because it's a generics business. Now, Organon, as you can see, is trading at $30, and they're trading a little bit more expensive on a forward PE basis. They're trading in the 5s and 4s. And I did a little delta there because when you're looking at a PE so low of like 4 or 5, honestly, it looks about the same. But the thing is 4 is not the same as 5. And so basically, the price earnings ratio at Organon is a full 34% higher than Viatris. And the price earnings ratio for next year at Organon is a full 22% higher than Viatris, as long as these analyst expectations are correct. Now, so what I'm trying to show there is Organon, it's more expensive than Viatris. Now, on a dividend basis, there's no dividend yet at Organon. Hopefully they'll bring one forth like their parent company pays. Market cap is tiny for this thing. It's only $7 billion, really small company. Long-term debt, $9 billion. Again, remember their parent company, Merck, has long-term debt of $24 billion, but this little $7 billion company has $9 billion of debt. And net margins are very similar to Viatris, 26.4% on a GAAP basis, but they may even be as high as 39%. When I was looking at their cash flow statement, there's some wacky stuff going on. I saw some nice margins when I was looking at Organon. And so with all of that, I want to get into some stock charts to help illustrate what I'm seeing with these stocks. And then I want to get into some more details from the Organon earnings release. And so check it out on the screen right now. I have some cool stock charts that I want to share with all of you that just helps illustrate this healthcare space. And so the first thing that I want to do is I just want to look at the parent companies, the big ones. I want to look at Pfizer, Merck, and J&J. Now, J&J didn't have any spinoffs, but it's one of the big companies in the space, so I want to see what it's doing. Pfizer is the dark blue. Merck is that yellowish, orangish color. Johnson & Johnson is the light blue. You can see over the 5-year period that Merck and J&J have performed about the same. They both performed very well, whereas Pfizer has lagged behind. And so maybe that's one of the reasons that Pfizer's PE ratio is a little lower as well, just in terms of an overall stock growth standpoint. Maybe it hasn't historically been growing as quickly as Merck and J&J. And so that's the first stock chart that I want to show. Now I want to go through some more, so let's keep going. Check it out on the screen right now. And so the next one that I want to show you is these stocks versus the S&P 500 and also versus Apple. And so S&P 500 is that darker orange color and Apple is purple. Thankfully, I own Apple in my personal dividend stock portfolio. You can quickly see that this entire healthcare space over the last 5 years has been lagging the S&P 500. And Apple has just been crushing it. And so there's 2 lessons from this chart. One, it's good to have high growth stocks even in a dividend stock portfolio because I'm a more conservative dividend stock investor. I invest for cash flow. I invest in stocks that help me sleep well at night. I like to buy stocks that are values, but sometimes when you're buying value stocks like the ones I'm seeing in the healthcare space, they may underperform the S&P 500, especially in shorter amounts of time like 5 years. And they've been slow. They've been slow these last 5 years. And so lesson one, though, is Apple, which has been one of the best performers in my portfolio, has helped compensate for that. And so I'm really glad that I hold that. Now, worth noting, though, Apple pays a very small dividend, and so it's really more of a long-term yield on cost investment for me. And quite frankly, worth noting, whereas most people care about aggregate portfolio value, I do only invest for cash flow. That's the component of my investments that I really care about, because I use cash flow to pay bills. And so that's why I gravitate to stocks like those presented in the video today. But I love having Apple in my portfolio. Now, the other takeaway from all of this is these healthcare stocks are underperforming the average, the S&P 500 index. And so that tells me a few things. It tells me one of two things. Either Ian, these stocks will continue to underperform the average because they're just slow growing stocks, or it tells me S&P is overvalued. It's been propped up by a lot of high growth like the FANG stocks, although Apple, I think it is reasonably valued. And hey, Ian, because they've underperformed, there's some good value in there, and it's probably not a bad time to buy. I look at it more that way, that I see value there. And when I see stocks underperforming the index, and I see stocks that are good values, that are good names, that are managed well, that have reasonably low amounts of debt, great margins, dividend growth, reasonable PEs, I get excited about it. And so the stock chart sometimes is the first thing that tells me, hey, Ian, this is an area of the market that you want to look at. Let's keep going. Check it out on the screen right now. And so the next stock chart that I want to share with all of you is just looking at Viatris and Organon. And so you can see in this particular chart, I have a few more stocks, and I'm showing basically that Viatris and Organon are underperforming. They're the laggards, if you will. They're not performing very well at all. And in that darker orange line, you have this time Organon, which is a newer company. And in the lighter blue line, you have Viatris, but they're both underperformers right now. And so again, though, that tells me sometimes you have a spinoff. The spinoff is saddled with debt. The spinoff is trying to figure out how to get on its feet. And Viatris, by the way, wasn't just a spinoff. It was a spinoff of Upjohn from Pfizer, but that combined with Mylan, which was an existing company. That's why it's a little bit bigger in scale than Organon, which to my understanding was more of a pure spinoff. But these spinoffs, they're struggling a little bit. They're struggling to kind of find their ground. They're struggling to get a start, if you will. And that could tell a lot of investors, hey, it's just junk. I look at it differently. I look, wow, if everyone else doesn't like it right now, that's something I want to look at because I'm seeing some value there. I want to keep going. Check it out on the screen right now. This is the last chart I want to show. And this is Carrier, which is another company that I own. Carrier was a spinoff from United Technologies, which is now named Raytheon Technologies. Carrier is one of the better performing stocks in my portfolio, just like Apple. And Carrier, when it was first spun off, wasn't doing well. It was kind of like Organon. It was kind of like Viatris. It was trading at a really low level. It wasn't really going anywhere. And then over the course of basically the last year and a half, it has totally outperformed the S&P 500. That's the lighter yellow line in that chart. Carrier is the blue line. And you can really see that this particular spinoff, yeah, it had some trouble finding its footing, but man, has it paid me well. As a dividend stock investor, it does pay a dividend for holding it over long periods of time. Which in this case was only a year and a half, so not that long. And so that's one of the reasons I like spinoffs, just like Peter Lynch, because they tend to do really well in certain cases, at least, like with Carrier. So now that I have all of that background and you kind of the stage has been set, you understand what all of these companies are. Quite frankly, I'll just give one thing before I head into Organon more specifically. I think all of them are reasonable values right now. I like all of the above, all 5 of them. The one I'm buying now is J&J because I'm focusing on my core. That's a realization I had when I was recently in Hawaii. I want to keep things simple. I want to focus on my best stocks, my favorite stocks. I have 51 stocks, but I ought to be laser focused on just a handful. I'm really diversified. I like it. All the different stocks on the team play a role, but I got to go with the big heavy hitters like J&J as well and stay true to those ones. And so anyways, that's where I'm at. But quite frankly, I could see myself buying any of these 5 stocks. Now, of all 5, I'd probably stick away from Organon just because it doesn't pay a dividend now, if they did initiate a dividend, that would greatly change things for me. But I am a dividend investor and I need dividends to pay my bills. And so it doesn't pay a dividend yet. So it's something that I'll probably watch and wait on. But also it's very duplicative with what I own at Pfizer, as is Merck, quite frankly. You may ask, why don't you own Merck? Well, I already have Pfizer. I already got J&J. I don't really need Merck. Same thing with Organon. I already got Viatris. Do I really need Organon? Do I need to really diversify that much? Probably not. But anyway, of the 5, they're all great. And so with all of that, check it out on the screen right now. I have some stuff I want to go through from Organon. And so the first thing that you will see on the screen is the income statement. This is the income statement from the 3 months ended March 31st. I'm just looking at their quarterly report, and you can see at Organon that the sales are down. And so again, worth noting with investments like Organon and Viatris, this isn't like investing in J&J or Pfizer or Merck, where they're generally at least staying steady at the top line, if not growing. This is a company that's shrinking a little bit. Although when I got into the cash flows, things were looking better, and I'll get into that in a minute. But that was the first thing I saw at Organon. That was a bit of a red flag, but it's also something eyes wide open as an investor in these type of really, really cheap stocks, dirt cheap, like Organon and Viatris. That's the reason the PEs are so low, is these are generic brands at this point that have in many ways been neglected for years by the parent company. And so you can see the net income as well is down. From the 3 months, comparable 3 months in 2020, it's way down. It's basically almost cut in half, 700 million down to 399 million. And so something to keep in mind. Although, again, when we look at the cash flows, things are going to look quite different. And so first thing to keep in mind, eyes wide open, getting into a Viatris or Organon type thing. It's a unique beast. It's trading at a PE of 4 or 5 for a reason. All right, check it out on the screen right now. The next thing I want to look at is just the balance sheet. This is a little misleading, and I really, really want to encourage investors on my channel who like to dig into various stocks like I do to not only look at the top level financial statements, but to dig into the fine print, because I'm going to get into some fine print. But when you look at this balance sheet, it looks all right. Assets, 2.9 billion. For current assets, for total assets, 9.6 billion. It's down a little from last year, but more or less looking good. And when you look at the liabilities, you have current liabilities of 2.8 billion, and you have non-current liabilities in there. Not that much. You have like a 1.8 billion line item and a 73 million line item. So you got some great shareholders' equity right there of 4.7 billion. And so you look at something like this from a balance sheet perspective and you're like, wow, Organon, it's trading, around that 7 billion market cap range. And you got your equity there of 4.7 billion. But there is no free lunch. This is something I've learned in life. There is no free lunch. And so you see these discrepancies in the financial statement that look a little too good to be true, and you got to dig more. So check it out on the screen right now. What I want to show you is some more information from the appendix of their financial report. And when I was looking in there, there's this footnote on debt, and it says bond assumption, and it says in April of 21, which is just after this financial release through March 31st, in connection with the separation, it's basically saying that Organon Finance is issuing all kinds of debt. There's all this debt and all these notes. They got them at different interest rates, different amounts. I'm going to show you a summary of everything on the next screen, but it's basically saying Organon Finance 1 was released as an obligor under the notes, and Organon Finance 1 used to be a subsidiary of Merck. Okay, it's being released, so Merck is no longer on the line for all of this, are they? And it says that basically that Organon is the one that's going to be taking on the remaining debt here and is going to guarantee the debt. And it's going to say, of all of this money, all of this debt, this $9.5 billion, 9 of it is just going to be paid off to Merck. And this is what's crazy. It says in the last sentence, You gotta read this. Organon used the net proceeds from the notes offering, together with available cash on its balance sheet and borrowings under senior secured credit facilities with Organon entered into, to distribute $9 billion of the $9.5 billion of proceeds to Merck, and to pay fees and expenses related to the separation. So this is really important. This wasn't captured on the balance sheet I just showed you, because that balance sheet was through March 31st. This is in April, but you got $9 billion, $9.5 billion of debt now taken on, where 9 is paid back to Merck, to the parent company. So the parent company, from a debt standpoint, is in a really good situation. The spinoff is in a really bad situation, hence the low PE. Let's keep going. Check it out on the screen right now. So the next thing I want to show you is it just shows you, here's a summary. You got your $9.5 billion, and it says, this is a summary of Organon's debt. This is long-term debt. We didn't even see any long-term debt on the balance sheet, and this is why it's so important to dig into the footnotes, because yeah, there's actually $9.5 billion of long-term debt, and all of a sudden, there's no shareholders' equity. There's no book value at this company. We thought there was some good book value. We thought it was trading at a reasonable price to book. It was looking really good. There's no book value. Now, I am not necessarily saying this is a deal breaker, but I'm trying to say there's no free lunch. And so, yeah, it's trading at a PE of 5. It's trading at a PE forward next year of 4 for a reason. There's no free lunch. Now, do I still think it's a value? Yeah, I think it's a value. Overall, am I going to be buying Organon? No. If I already owned Organon because I own Merck and I got the spinoff shares, would I hold it? Hypothetically, yes. Would I be buying more? Probably not really, because they're not going to pay a dividend yet. But if they initiated a dividend, yeah, I'd probably look to pick up some. But that's kind of how I'm looking at Organon. But let's keep going. Check it out on the screen right now. And so the next thing that I want to go through is cash flow. Now, this is a bright spot. And you remember the net income, wow, is way down year over year. It was at 734, and now it's at 395. But if you actually look at net cash flows provided by operating activities, it's actually up year over year. And the big reason for that is there's a line item that says due to related party. So there's some kind of line item here of 769 million that is bumping up the numbers. And so whereas GAAP EPS look pretty bad and GAAP earnings look bad, on a cash flow basis, which is actually more important, in my opinion, than GAAP earnings, they're doing all right. So that was good to see. Also in the cash flow statement, it looks like cash flow from investing activities, nothing crazy there. It looks like cash flow from financing, nothing too crazy there. And so when you jump all the way at the bottom and you look at just like cash and cash equivalents end of period, they're actually growing their cash and cash equivalents over time. And so I really like seeing that with Organon. And so whereas their income statement didn't excite me too much, cash flows do. I feel good about that. Balance sheet, I feel pretty bad, but anything in this kind of spin-off situation in healthcare, it's just like Viatris. It's got the same problems on the balance sheet that Viatris has. The question is, are they going to generate enough cash flow quick enough to pay down a lot of that debt and move on? That's kind of how I look at Viatris and Organon as well, as in the short run, it may be kind of, it may not be really going anywhere. But in the long run, looking 5-10 years out, if they can just pay down and eliminate a lot of that debt, there could be huge opportunity for these companies to thrive and just to be cash machines, if you will. And as a dividend investor who likes to pay bills at dividends, that's what I like, is cash machines. Anyway, let's keep going. Check it out right now on the screen. I want to go through the Organon geographical breakdown. You can quickly see that this company is majority non-US. That was something really cool about Organon. They do a lot of business internationally. And so you see that right there on that particular screen. The next thing I want to show on the next screen is they just made an acquisition. Check it out on the screen right now. It's nice to see that they're really doubling down on women's health, and they bought Lydia Health. This is a medical device company focused on postpartum hemorrhage, and so that was nice to see that they are really staying true to that charter of women's health. And it's nice to see them to get in the medical device arena, which I think is a good way to diversify against, biosimilars and generics. And so that was something nice to see at Organon. Let's keep going. Check it out on the screen right now. This is what I was telling you a while before, why I think it could be a value, because there are basically this mini tender offer. You can see right now Organon is recommending that stockholders reject it. But sometimes when these kind of private equity firms or these kind of investment firms who are maybe sometimes hostile or maybe not, sometimes just trying to be working with the management teams to kind of improve upon things. They're kind of these private equity firms, if you will. I don't know about TRC Capital, but they're trying to buy up a bunch of shares. When I see this kind of news out there, it's usually a signal to me that there's opportunity. It's usually a signal to me that if the private equity firm sees value and they're trying to buy up a bunch of Organon, usually they wouldn't be trying to do that unless it's a value. And so that's validation to me. Hey, everyone hates this thing now. It's got a lot of debt. It's got a low PE. No one's really looking at it. They're all looking at Merck, J&J, Pfizer. No one's looking at the spinoffs. They got all that debt. And so the people that are looking at it, sometimes they're savvy money. And so that gives me a lot of hope about Organon. Let's keep going. Check it out on the screen right now. This one's for my homies who work over at Organon. If you're watching, you got a typo on your website. Your market cap is not 782 billion. That would make you larger than Johnson & Johnson. And so I just wanted to point that out to my friends who are over at Organon, if you're watching the video. And I want to go quick right now and just summarize everything. So check it out on the screen right now. In summary, Organon is a spinoff from Merck. It's focused on women's health, biosimilars, and legacy brands. Legacy brands, largely generics. It was spun off on June 3rd. It's been trading over a month. Every Merck share that someone held before the spinoff, they received a tenth of an Organon share. It has a really low PE, just like Viatris in the 4s and 5s. There's no dividend yet, but I would hope one would be on the way. In many ways, it's very similar to Viatris, although not quite as cheap. It has reasonable margins, has lots of debt. It's a business, I would say, that's somewhat in decline, but maybe now that it's a standalone company, maybe that will change around, because I think when it was at Merck, no one was focused on these legacy brands. Same with Viatris. When it was at Pfizer, no one was really focused on these legacy brands. Maybe now that these are separate businesses, they'll get a little bit more love on these legacy brands, and they'll figure out some clever ways to grow shareholder value and value for customers as well. In conclusion, I would say it's not for me because I don't own Merck. I would say, though, if I did own Merck, hypothetically, and I got the spinoff, hypothetically, in my personal situation, I would probably hold my Organon. I would hold the spinoff. And if a dividend was announced, I'd probably buy more, just like I'm buying Viatris right now. I'd look at it like Viatris. And I don't need another Viatris now. I've already got Viatris, so I won't be buying Organon. I'm trying to focus also on quality, as I mentioned, so I'm really looking at J&J these days to accumulate way more J&J and keep pushing that position larger. That being said, every stock in my portfolio plays a role, and I'm glad I own Viatris. And so if you enjoyed the video today, the analysis today, please go ahead, smash the like button. It is the greatest way you can repay me, by smashing the like button, but also by going ahead and subscribing with the notification bell. I am racing against myself. It's an individual race, I guess, to get to 100,000 subscribers. I want to see, hey, can I do it this year in 2021? We shall see. But I want to bring the dividend stock investing message to as many people around the world as possible. These days, I'm especially focused on reaching people who are beginners. I'm focused on reaching people who have never done dividend investing before, or I'm honestly trying to reach people who have never invested before. I want the message out there because I think it's really important to society. I think society right now is at an inflection point. It scares me, honestly, what's going to be ahead 20 years from now. Now is the time, in my opinion, that worldwide people understand that, hey, dividend investing is there for them if they want it. And so with all of that, check out my Patreon as well. Link to it in the pinned comment below. I love you all. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. It's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a lot of money in the stock market, especially with stocks that are a little more risky, like an Organon or Viatris. Before I leave today, in terms of full disclosure, I own a lot of the stocks mentioned today. I am long Pfizer, ticker PFE, Viatris, ticker VTRS, Johnson & Johnson, ticker J&J. I am long Apple, ticker AAPL. I am long Carrier, ticker CARR. I own all of those stocks in my personal dividend stock portfolio. I love you all. I'll see you in the next dividend investing video.